All right, so we are looking at accelerated methods of depreciation. We just looked at some of the year's digits. Now we're going to look at the double declining method of depreciation. The double declining method uses the straight line method or straight line rate to depreciate an asset at an accelerated pace. What makes this different from the other methods that we just discussed is that we concentrate on the ending net book value or beginning net book value, right? The ending net book value of 1 year is the beginning book value of the next year. We concentrate on book value instead of depreciable cost. Make sure you understand the difference between those two. Book value, which is stated on the balance sheet, cost minus accumulated depreciation, is different than the depreciable base. The depreciable base of an asset is the cost of an asset minus its salvage value. So, with the double declining method, we'll have a rate that we apply, and this remains constant through the life of the asset and our depreciation of this asset. This rate that remains constant is applied to the net book value, not the depreciable base. So initially, except for the last year of depreciation, we ignore salvage value. During the last year of depreciation, we will need to adjust our depreciation expense so that after we've depreciated this asset completely, we are left with the salvage value on the balance sheet. In other words, we do not depreciate below the salvage value. All right, I think we're ready for E14 with the double declining method. Here we go. Year 1 depreciation. What's the book value when we bought this in May? It's what we paid for it, right? We haven't used any of it yet to generate revenue. So this $315,000 is our book value at year 1. Now remember that our estimated useful life for this asset is 10 years. Now let's think about this rate. And let's go back to how we introduced this and how it's tied to the straight line method. When we did straight line method for this asset, essentially what we were saying was each year of depreciation is equal to 1/10, 1 out of 10 years. Or if we think about it on a monthly basis, it would be 1 out of 120 months. This would be 10% each year, right? So when we use the double declining method, we take this straight line rate, we multiply it by 2. So our double declining rate equals 2 times 10% or 0.20. So let's use this rate to get our year one depreciation expense. We bought it in May, so we will account for that, applying 8 out of 12 months of depreciation. And we are applying this to the book value, which is $315,000. This comes to $42,000 in year one depreciation expense. Let's take care of year two. We depreciated 8 months worth in year one because we bought it May 1st. So we'll take care of the remaining 4 months by using our fraction 4 out of 12 times our double declining rate. Now pay attention to this. We're still in year one of our depreciation. We're in year two of our accounting records. But if we're thinking about book value for our first year of depreciation, it's $315,000. When we do this math, we have $21,000. Now let's think about book value of the asset when we get into our second 12 months. So what would be our book value May 1st, year two? Well, so far, we would have depreciated this asset by $42,000 in year one and $21,000 the first month of year two. That comes to $63,000 in accumulated depreciation. So on May 1st, year two, our book value is equal to our cost, $315,000, minus the depreciation that we've taken up to that point, which comes to $252,000. So using this book value, let's take care of the remaining 8 months of depreciation for year two. We've got 8 out of 12 months left. We have our double declining rate of 0.2, and we have our beginning book value at this point after 12 months of depreciation of $252,000. This comes to $33,600. So we've got 4 months of this year that comes to $21,000. The remaining 8 at $33,600. Year two depreciation expense, therefore, comes to $54,600. Let's finish this out with a couple journal entries and then thinking about book value at the end of accounting year number 2. Year 1, depreciation expense debited for $42,000, accumulated depreciation credited $42,000. Year 2, we have depreciation expense, a debit of $54,600, and accumulated depreciation, $54,600. Over those 2 years, or really 18 months, the total depreciation that we recorded under double declining balance comes to $96,600. So book value at the end of year 2 would look like this in the balance sheet. Our cost, $315. Accumulated depreciation of $96,600 would give us an ending book value of $218,400.